All right, let's talk about profitability. Now, you might think of it as just a single number at the bottom of a spreadsheet, right? But I want you to forget that. Today, we're going to look at it like a complete toolbox, packed with different gadgets, each one designed to help you make really smart business decisions. So, let's get this thing open.
Okay, imagine this. You're a manager, and you've got $1,000,000 burning a hole in your pocket to invest. You've got two projects sitting on your desk. You can only pick one. Now, both of them look pretty good, but they're good in totally different ways. So, how do you make the right call? This exact situation is why profitability analysis was even invented. And here's the classic dilemma, right? On one side, you've got Project A. It's the sprinter. It's all about speed. You get your initial investment back fast. But then you've got Project B, the marathon runner. It's the long game. Yeah, it takes more time, but the total payout is way bigger. So what do you value more? Quick cash or the biggest prize? There's no single right answer here. It really all depends on what your company needs right now. And this is exactly where our toolbox comes into play. I mean, think about it. A mechanic wouldn't use a wrench to hammer in a nail, right? It's the same idea here. A financial analyst needs different tools for different questions. We're about to pop open this toolbox and see what's actually inside. So our toolbox is basically organized into two main trays. In the first tray, we've got all the tools for picking specific projects, like trying to choose between our Project A and Project B. And then in the second tray, we've got tools for grading the overall financial health of the whole company. Let's start by opening up that first tray. So how do we actually choose a winner? Well, this first set of tools is all about putting different options head to head to see which investment makes the most sense for the business at this very moment. The first and honestly the simplest tool is called the Payback Period. It answers one really simple question: how fast do I get my money back? For a project like our speedy Project A, this is the metric you'd be looking at. It's super easy to understand, and it's especially handy when things feel risky and you just want to get your initial cash back as quickly as humanly possible. Next up is a classic you've almost certainly heard of, return on investment, or ROI. This one is all about the bang for your buck. It's a fantastic, quick way to see how efficient an investment is. But both Payback Period and this simple ROI have a massive blind spot. They totally ignore a fundamental concept in finance that, well, it changes everything. And that concept is the time value of money. It sounds fancy, but the idea is simple. A dollar you have in your hand right now is worth more than a dollar you'll get a year from now. Why? Because you could invest that dollar today and start earning interest on it. The next two tools we're going to look at are way more powerful, precisely because they get this. So say hello to net present value, or NPV. This is a real game changer. What NPV does is it takes all the money a project is going to make in the future and it discounts it, which is just a fancy way of saying it calculates what that future money is worth in today's dollars. This lets you take a messy stream of future payments and boil it all down to one clean number you can use to compare projects right now. If the NPV is positive, the project's a go. Then we've got the internal rate of return, or IRR. Now, if NPV gives you a dollar value, IRR gives you a percentage. You can kind of think of it as the project's own personal interest rate. And what you do is you compare that percentage to your company's hurdle rate, which is just the minimum return a company wants to see before it says yes. If the IRR is higher than your hurdle rate, boom, you've got a winner. And here's a really fascinating bit of trivia. For decades, there's been this big debate. Academics love NPV because it's technically more accurate. But in the real world, a survey of Fortune 500 companies showed that executives preferred IRR by a whopping 3-to-1 margin. Why? Because it's just more intuitive. It's a lot easier for a CEO to get behind a project that's returning 18% than one with an NPV of, $1.2 million. Okay, so we've looked at the tools for picking individual winners. Let's close that drawer for a second and open the next one. Now we're zooming out from a single project to the big picture. How do we grade the profitability of the entire company? The first metric in this tray is return on assets, or ROA. This is a really powerful way to measure efficiency. It answers a beautifully simple question. How good is this company at using all of its stuff, its factories, its cash, its computers, to actually make money? It tells you how well management is using what they've got. So to see how this works, let's use a quick example. Our fictional Acme construction company. This table shows their key numbers for the year. Now, to calculate their return on assets, we only need to pull two numbers from this list, their net income and their total assets. Let's see what that looks like.
So when we run the numbers, we just take Acme's net income of a little over $1.1 million, and we divide it by their total assets of about $3.5 million. And boom, we get a return on assets of 31.8%. That percentage is a super powerful benchmark you can use to see how Acme is doing compared to last year or even compared to its biggest competitors.
But what if we want the ultimate test? What if we want to know if the company is truly creating wealth? Well, that brings us to economic value added, or EVA. This method asks the toughest question of all. After you account for every single cost, including the hidden cost of the money that was invested in the business in the first place, is the company genuinely creating new value? So let's look back at ACME. After we take their operating profit and subtract the cost of all the capital they used, we get a positive EVA of over $820,000. This is fantastic news. It means ACME isn't just making a profit on paper, it's generating real, actual economic value for the people who own it. So, we've seen all these different tools in the analyst's toolbox, right? NPV, IRR, ROA, EVA. But with all these options, what's the single most important thing to remember when you have to make a decision? This brings us to the golden rule, and it comes straight from the source material. It's basically this. The specific tool you choose, it's not as important as being consistent. Whatever method you pick, whether it's the simple payback period or the complex NPV, just make sure you use it the same way for every single option you're considering. That is the secret to a fair comparison and a decision you can stand behind. And that leaves us with one last thought. Profitability isn't just one number. It's a whole story, told through a bunch of different lenses. Now that you know what's in the analyst toolbox, the next time you hear a company boasting about its profits, you can ask a much better question. Oh, really? Profitable by which measure? Thanks for tuning in.